The topic we're going to be covering today is what is comprehensive asset allocation? And this is the idea of when individuals take into account all the assets that they have when they're making decisions in their investment portfolio versus when individuals isolate the assets that they have and fail to consider how the other assets that they own relate to their investment portfolio. And one way we see this show up frequently, well, we see it in a lot of ways, but one example is in individuals' 401ks or their savings plan. Let's say that an individual has $500,000 in their plan through work, and that they have 50% of that invested in stocks and 50% invested in bonds. And let's say they're 55 to 60 years old. On its own legs, that seems like a pretty solid mix from a risk perspective for someone approaching their 60s to be taking. But let's also say that this individual has a pension that pays them $2,100 per month. Well, let's take a step back. What we want to do is properly classify that pension as an asset. And if you think about something that pays you a fixed amount every single month into perpetuity, you could think about that as a bond. And in fact, what you can do is convert that cash flow stream, $2,100 per month, into a lump sum or a pile of cash to see what is your overall portfolio worth. And if we take $2,100 per month using a 2% interest rate to discount that back today for a present value, we can come up with an asset worth of $500,000. So when we put that together with this individual's 401k plan, they have about $1 million portfolio. But what we can ask now is, how should we be invested in that 401k given that we know this pension is like a big bond and it makes up $500,000 of your overall portfolio? Again, we're getting to this idea of a comprehensive view of your asset allocation. Well, this might allow the individual to take on proper investment risk. If you think about it, this individual is really only 25% stock, 75% bond. That might drive this person to say, well, I think I want to take a little bit more investment risk in my portfolio to balance out my comprehensive asset allocation. That can also help individuals earn a higher rate of return on their assets by fine-tuning the risk they're taking in their 401k in the context of all the assets that they own. But that's just one example. We can also see this for someone that's in real estate. Should someone that, sells houses for a living have a large portion of their investment portfolio invested in real estate? Probably not. Someone that sells bonds for a living, should they invest in bonds in their retirement accounts? Probably not. If you have a tenured professor that has a salary that jumps up every year, maybe for inflation, but is pretty steady and stable, can they afford to take on some more risk in their retirement portfolios? Absolutely. Well, what if you are all commission based in the job that you do today? Does that mean you should invest primarily in stocks in your portfolio for the long run? Maybe not. Maybe you should balance out how your income behaves with how your retirement portfolio is invested. All these things can be helped answered through understanding what your comprehensive asset allocation is. And so there's lots to unpack here. We'd love to help you navigate through this. So feel free to leave comments or questions below. We'd love to engage with you there. Don't forget to like and subscribe. And until next time, have a great day.